Hello everyone, welcome back to the video analysis series. Today we will be talking about FMCG valuation and why these companies trade at such a high PE multiple. We regularly hear from market that it is difficult to make money if you are investing in a companies which are trading at 40, 50 kind of PE multiples when other companies in this market are trading at half of the valuation. Let's dig beneath the superficial understanding of just the PE multiple. Let's move our attention away from PE multiple and for a while focus on dividend yield. On dividend yield, average dividend yield for FMCG companies in India, the few six companies which we have taken for our consideration, is about 1.6%, while the dividend yield of Nifty 50, which has been taken from NSE website, is about 1.43%. We all say that investment is all about cash flow. What matters at the end is how much you get back in form of cash or dividend from the companies. That why we leave this logic behind when we are talking about FMCG companies. I think the reason could be because it takes an effort to think beyond a surface level of PE multiple and go back to understand how the cash flow is generated, how the cash come back to the shareholder, and hence we find it comfortable to recommend other companies which are trading at half the valuation rather than FMCG companies which are trading at 50 to 60 kind of PE multiple. Second aspect I want to discuss is volatility in earning. Let's see the reason why PE multiples of FMCG are generally high in India. A company will be assigned a higher PE multiple on quality of earning. What do we mean by quality of earning? I can assign the stability of earning and my ability to forecast for a longer term as quality of earning. The quality of earning can be gauged from how much there has been volatility in terms of sales growth or operating margin. Barring few years, FMCG companies deliver consistent sales growth and their operating margin is also very much stable. This lower volatility in profitability helps in assigning a higher quality of earning and higher ability to project the earnings for the future, and that's the reason why we give higher multiple for FMCG companies. Third aspect I want to discuss is about longevity. Let's think about how long we can assume these FMCG company will remain a dominant force in Indian market, given their brand dominance, customer attachment, and acceptance of their product and brand, and deeper penetration within the country. Today we can assume that all these companies mentioned will be a dominant brand in India for many decades to come. Hence, I can take a very long-term view of these companies, may not be the case in case of commodities companies or B2B companies. Even if we assume that leading FMCG companies versus the private banks, which are also equally dominant brand, my ability to forecast for a longer term horizon get curtailed even for a brand like HDFC and Kotak. If I can assume a brand like Nestle or HUL can stay as a dominant brand for next 30-40 years, similarly I can assume that a HDFC brand like HDFC or Kotak will be a dominant brand or dominant bank in India for next 10 years or so. So my longevity of or forecasting for FMCG companies actually increase multifold, and the reason is because the brand acceptance among the consumer is so high that helps me to forecast this company will remain a dominant force for a very long period of time. Another thing talking about brand is anti-fragility nature of these companies, which can be taken from the book of Nassim Nicholas Taleb. FMCG brand has been in existence on average more than 60-70 years. Hence we can forecast that they will be in existence for next 50-60 years. Comparatively, if we compare the dominant banks, the private banks in India, they are been in existence for last 20-25 years. So again, the same reason, the ability to forecast for a very long period of time is much better when I am seeing the FMCG companies whether versus the banks, the private banks. The fourth reason I want to discuss for FMCG companies are its lower beta. Say if FMCG companies trade at 0.5, 0.6 kind of beta and this lower beta provide a comfort to the portfolio in terms of lower volatility whenever there is turmoil in the market. Hence, despite being these companies at a much higher valuation, they give comfort to portfolio construct in reducing the risk for the portfolio. Having a companies which are 0.5, 0.6% beta, 0.5, 0.6 beta will reduce the volatility for a portfolio level. Lastly, I want to talk about a valuation model, DCF. We will take into consideration the beta which we have seen earlier and find out what kind of DCF model can be constructed and what kind of difference it makes on the final valuation. When we are talking about FMCG companies, the beta there is about 0.5, 0.6. The market beta is about 1.0. If we take a risky company, something like Tata Steel, the beta would be 1.4x. Uh, what we have done here is computed the beta directly from money control, taking it from money control because it's readily available. But you can use Bloomberg or other database for a longer term beta. Now, to do a DCF, what we need is a risk-free rate. Risk-free rate in India is 7.3%, the government 10-year GSEC rate. Then we need a beta for individual company or sector, and then we need a risk premium. We can assign a 6% risk premium for investing in equity in the Indian market. So if I compute the cost of equity for FMCG companies, it would be 7.3% risk-free rate, 0.55 beta of the FMCG companies, and multiply it by the risk premium, which is 6%. I come to 10.6%. This would be my discounting rate for all kind of cash flow which is generated from FMCG companies. Similarly, I go back and calculate the cost of equity for the market or index. It would be risk-free rate, and beta for market is always 1, and multiplied by market premium. Then I come to cost of equity, which is about 13.3%. Similarly, if I take a higher risk company, which is like Tata Steel in our example, the risk-free rate multiplied with market premium multiplied with beta, we get a cost of equity which is about 15.7%. We will see how a same cash flow can make starking difference in terms of present value if we are discounting them with a different cost of equity. If I am discounting 100 rupees cash flow for FMCG companies, I am getting a valuation of somewhere around 940 rupees. Similarly, when we are discounting the Nifty 50 companies, which is at 13.3%, I am getting an NPV of 750 rupees. While Tata Steel, if I discount it for 15.7%, I am getting a NPV of 640 rupees. Now you see how the discounting rate, which has been different because of beta, because of lower volatility, impact our net present value of same cash flow, which is 100 rupees. Now here we have assumed that the cash flow is consistent, the same 100 rupees which we get for every year. But normally in DCF we do a terminal value kind of valuation. And now we will see how, if we are doing a terminal value, the valuation will, a difference between say FMCG companies and Nifty 50 or Tata Steel will be even bigger if we are doing it on a terminal value. Because when we are doing a terminal value valuation, instead of cost of equity discounting factor, what we take, the discounting factor is a difference of cost of equity and our terminal growth rate. The terminal growth for FMCG companies versus other companies, the difference of growth rate comes down dramatically. Hence, when we are taking a terminal value for FMCG companies, we assume somewhere around 6% kind of terminal growth. And if we are taking a Nifty 50 companies, we can assume somewhere around terminal growth of 7%. Now the cost of equity, which was earlier the pure cost of equity, is been replaced by cost of equity minus the terminal growth rate, and hence that discounting factor, the difference is for FMCG companies we are taking a discounting factor of 0.46%, 4.6%, while for Nifty it is 6.3%, and while for Tata Steel it is 7.7%. And hence we for the same kind of cash flow, which is 100 rupees which will be generated, we say that NPV for FMCG would be 2170, while for Tata Steel it would be somewhere around 1300. And hence we see that we assign a different discount rate because of this terminal value and terminal growth rate. The multiple which happens for FMCG companies, the difference which happens for FMCG versus other companies are growing larger. Now let's come down to discussion of when we see this valuation of 50-60 multiple for FMCG companies, whether to invest in those companies or not. What we look forward after seeing this valuation multiple, we should see how much the company has been traded for last say 5 years, and how much has been the the valuation multiple now, and where is the difference lies. Also we should see how much the growth rate for the company has been for past 5 years, and what forecast we have for future. If we have similar growth rate in sales and profitability for future, and the companies are trading at a much lower PE multiple, then it makes a case for investment. We have outlined few companies how they were trading for last 5 years and where the valuation multiple is now. We have highlighted Dabur and Marico differently because here the current PE multiple is not for only for March quarter. Because the March quarter multiple was very depressed, we have taken the full year multiple for Dabur and Marico, and simultaneously we see that the March quarter annualized PE multiple for Colgate is very low. This is because of two factors. The March quarter operating margin for Colgate has been very high compared to all the previous years, and the other reason is there is a risk from Patanjali. And then we see that the growth rate for different FMCG companies, we see that the companies which have a stronger brand and continue to grow at 10% or something like that, they command a much higher premium. Similarly, a companies like Colgate, where the growth rate has been low in the past, their multiple has been coming down. We have talked about what comfort these FMCG companies which has lower volatility brings to portfolio. But on the flip side, we should also consider that there can't be a significant re-rating in a PE multiple, because they normally trade in a narrow band of that PE multiple. The share price goes up, but because of EPS going up and down, but PE multiple of these companies are fairly stable if you see for a longer time frame. In case these companies break their band of that 8%, 10% growth rate and grow for 14-15% for few years, there is decent chance of a PE re-rating. But here again, the PE can't go significantly higher from its historical level, because we can't assume for a very long period of time the growth rate would be very high from its historical level, and hence there would be small extra return which can be generated. I hope we have discussed enough about FMCG valuation. Finally, all the examples we have taken today, it's only for education purpose and nothing should be construed as an investment advice. In case you like the video, please share it among your circle and do subscribe the channel for getting more informative investment decisions. Thank you.